September has been a difficult one for traders thus far, with equity markets moving towards the downside amid recession fears. Well, we've essentially got to try and ascertain whether this is justified, whether this is an opportunity to buy the dip, or are we due further downside? So let's get into a deep dive on the US economy and the outlook for equity markets and some commodities and the US dollar alongside that. So plenty of slides to get through. The big question here is, should we buy the dip and when should that happen? First and foremost, there's a number of different things that people are obviously looking at in the market right now as potential justifications to worry about the possibility of a US recession. And that has been sparking risk-off sentiment throughout equity markets. One is the yield curve inversion, but instead of the inversion, which has been talked about for a long time as a precursor to recessions, it's the uninversion. So we've seen a move back up above that zero threshold for the 10-year minus the 2-year yield spread. That in the past has heralded or acted as a precursor to recessions over in the US. And so whether it's going to be any different this time around remains to be seen. But certainly, given the fact that we've been seeing some weakness across a number of different parts of the economy, most notably the jobs market, that really does bring the question of whether we're going to see a recession into light once again. That US yield curve move towards the upside in terms of the 10-year minus the 2-year also tallies up in terms of correlations with these two different lines as well. You can see here the unemployment rate has been moving towards the upside. That's certainly a big topic recently within markets, but also that move higher in terms of the view of the consumer. So things starting to shift away from where you want them to be, essentially, and points towards a possibility of a recession and a resurgence in terms of unemployment. Part of what has been driving market weakness recently has been the ISM manufacturing PMI. Now, it's interesting because the manufacturing sector is something like 10% of the US economy, but nonetheless, it really has sparked a significant risk-off moves when we see that breakdown, as we do with the ISM numbers, that shows weakness in terms of output, weakness in terms of new orders, strength in terms of prices, which is what we don't necessarily want, and weakness in terms of the employment situation. But nonetheless, as we can see here, that this correlation between the likes of the GDP number and manufacturing, actually, it hasn't necessarily been particularly strong recently. The relationship between GDP and manufacturing hasn't really been there of late. So whether we can continue to see that remains to be seen. Now, excuse me, I've tallied up the likes of the manufacturing, the services, and the composite ISM PMIs here, and essentially put them onto a chart so we can see exactly how things have looked in the past when we've seen recessions and try and gauge exactly where things stand. Probably best for me to get rid of my head and you can see it a bit closer here. Essentially, what we've got is that we've got services still in expansion territory. We've got manufacturing in contraction territory. And the fact that we've got such a strong weighting towards the services sector means that we've got the composite number in expansion still. So this points towards positive growth. But nonetheless, we certainly still do have some concerns because if you look in the past, generally, certainly if you look at it on the left-hand side of this chart, you can see that often it's the manufacturing sector, which is the light blue line, that leads the rest of the economy lower. And we can see that once again here. It's certainly been leading the way into contraction territory over recent years, as we now see the services sector moving towards the downside. Excuse me, that's not the view that we want. There we go. And so it's interesting to note that, look, manufacturing can be important as a precursor to the rest of the economy. But if it's only manufacturing that's weak, and that has been something that's been happening over recent years, then it's not necessarily too much of a concern. Now, we can see here in terms of the ISM services PMI that generally the relationship between the services PMI and this is the one-year change of the S&P 500 has been very close in the past, right? So if we see a deterioration in terms of the services sector, that does hit the S&P 500. And so what we've actually seen here is a divergence. We've been seeing the S&P 500 on this one-year change basis moving towards the upside and only just recently turning around, whereas the the services PMI has been moving towards the downside, moving closer and closer to that 50 threshold. Now, as long as it remains above 50, it's fine. But if we get back below 50 on that ISM services PMI, that could really be a warning sign. And the problem here is that, look, we need to see the Federal Reserve act. But there's a question mark on whether they're going to act too late, because they obviously want to wait until inflation sort of drops out of the picture. They don't want to move too early. But if they wait too long, then we could get ourselves into a position where the US drops into recession, and their interest rate cuts take some time to feed through, and therefore they're going to be acting too late, and we're going to have a protracted period of downside in terms of the US economy. But at the moment, as long as it remains above 50, things are all right. Certainly with the fact that we've got this close correlation, the potential for that divergence to narrow points towards either further weakness in terms of the S&P 500 as we see services continue to flounder or moving towards 50, or else a move higher in terms of the services PMI number. So one of the two could happen, and so that's why it's so notable to look out for that services PMI. This has been suddenly on everyone's radar, right? Which is the SARM rule, which is, as we say here, percentage points difference between the 3-month moving average, the unemployment rate, and the minimum 3-month unemployment rate over the previous 12 months. And essentially, once we rise to 0.5 or above, then it triggers it. And in the past, it's called every recession. And now we're at 0.6. So we've seen that enacted. It points towards the possibility that we're about to see a recession. And so this really highlights the fact that part of this is about the jobs market. And some people might say, well, whether we see a weak jobs number in terms of job creation or unemployment, that doesn't necessarily mean that businesses are going to suffer. But of course, it is a bellwether for the business conditions within the economy at the time. And so if people are being laid off, that's indicative of a business environment where companies don't feel confident being able to hire people. And so if we look in terms of the US jobs market, this is, let me go full screen again. This is a sort of breakdown across a number of different metrics. Now, the reason I like to look at this is because this gives you a view not only within the past, say, 12 months, which is what we often do, right? We want to see exactly what the trajectory is over the near term, but this also shows you what the status quo is prior to the pandemic. So are we at just territory seen prior to the pandemic, or are we actually now getting into a concerning area? Well, let's look at some of these. First and foremost, payrolls. It's quite difficult to ascertain here because those big moves that we saw around the pandemic. But we're now around the sort of 100K kind of mark. And prior to that, the average was maybe 150s, 170s prior to the pandemic. So we are a little bit weak on that payroll side of things. In terms of the sort of, we've got the job openings, the quits, the hires, the layoffs and discharges. I would say the hiring rate is important, but probably more notable would be layoffs and discharges, because if we're seeing businesses laying off workers, that really points towards them drastically trying to cut costs. We haven't necessarily seen a major move towards the upside for that. We have seen a decline in terms of quits, and quits is a nod to how people are feeling, whether they're confident to just quit their job because they think they'll have another one. But we've seen that declining. And so certainly from a worker's perspective, the confidence isn't necessarily there, but we haven't seen this big spike in terms of layoffs and discharges quite yet. Elsewhere, unemployment pretty much back where we were before, but you can see bottoming out a little bit as we saw with the SARM rule. And then the participation rate, getting back pretty much where it was before. So that's one look at the jobs market. Another area is talking about these downward revisions. This is why we've started to see some of these concerns really arise recently, because we've not only, seen jobs numbers in the past and said, these look fine, US economy's pushing strongly higher. Well, now more recently, we're seeing this massive raft of downgrades, and you can see it with these red shaded areas. In the past, we've seen general upgraded revisions. This time around, we're seeing regular downgrades, and I've got them here so you can see most recently some pretty hefty ones. You're talking about 67K, 56K, 88K over recent months in terms of how much they're knocking off of previous announced NFP numbers, 97K as well. So certainly this is a bit of a shift. And it does point towards a weaker picture in the US in terms of job creation than had previously been announced. And certainly some of these also, some of the strength we'd been seeing previously were temporary roles anyway. So, there had been some questions being asked around the time of these announcements in the first place, because people were saying, okay, we've got a strong jobs number, but a lot of them come from temporary roles and people taking on a second job rather than a single job creation or full-time roles. But nonetheless, we've seen these downward revisions. So again, a warning sign in terms of the job side of things. Then this is the NFIB. This is the job creation plans for the next 3 months. And this is for sort of smaller businesses. You can see that this has been dropping off. Now, we're not necessarily dropping off into the kind of levels where we've typically seen recessions in the past, which are these shaded areas, but we're certainly heading in the wrong direction. And so if we continue to see declines in terms of planned job creation, then this again would point towards weakness within the jobs market, the potential for a recession. But we're not there at the moment. And that's key. The question mark here is, do the Fed need to act? Yes, very clearly. Are we in a point where if the Fed don't act in a very dramatic manner, we're suddenly going to get into a recession? That remains to be seen. And then the question mark of how long after the Fed starts to act does the economy really pick up? Do businesses immediately say, wow, you've done a 25 basis point cut, I'm going to immediately start to hire people? Or is it going to take a longer period of time? I think it's probably that second option, quite frankly, because lower cost of borrowing takes time to feed through into the economy, where individuals take different decisions, where businesses take different decisions. It's not an instantaneous thing. We have seen a rise in terms of credit card delinquencies. So this points towards not only people taking on additional debt to be able to maintain their quality of life, which has happened around this cost of living crisis, but also delinquencies on that. So people being unable to pay it. So we would expect to see this pushing sharply higher if we're seeing really dramatic concerns within the US economy. Certainly, it's not necessarily a great position, but in the past, where we saw it in the sort of run up to the 2007, 2008 recession, we were above where we are at the moment. So we need to see further upside for that. This is a chart that I thought I'd throw in to sort of highlight why there should be some optimism within markets and why we generally see markets move towards the upside. And that's why we have seen strong buybacks from businesses. And so when we're talking about major sell-offs for the S&P 500, we're seeing buybacks moving towards the upside. And as long as we move into a phase where buybacks continue to grow, that is very supportive for equity markets. And the reason for that is that when we're looking at earnings, so let's say earnings per share as a metric, that is driven by your earnings and your profits, but also the number of shares that are in circulation. And so if we see businesses doing well, which many of the big businesses have done, and Nvidia just recently announced a massive buyback scheme, their way of spending money, certainly the very profitable ones, which the Mag 7 generally are, their way of spending that money a lot of the time is through buybacks. And by buying back their stock, it means it increases that earnings per share outlook going forward. And earnings underpin strength for the equity markets. Part of why we're seeing the weakness at the moment is down to September weakness, but that can also lead to strength in the month after. So what we want to look at here is, why are we seeing weakness right now? Well, September generally is that period at the back end of the summer holidays. People come back to their desk. You might see some volatility around that. Historically, we've seen September representing the worst month when it comes to equity markets. As you can see here, it's the standout underperformer. And so we're just in the middle of that, right? And so if we look forward, the question mark here is going to be, do we buy the dip? And when do we buy the dip? Like we've seen here, generally it's October that we see the rallies start to take shape rather than September. So we have started to see the equity markets perk up a little bit, but there's still some question marks because maybe 1 week of major declines won't be enough. As you can see in terms of seasonality on a sort of linear basis, we can see here over the 20-year average, generally September sees quite a lot of jitters. It bottoms out into the beginning of October, and then we start to build from there on in. Of course, we're only, as I speak, a third of a way through September. That points towards a possibility of further downside as we move forward. Another area to be looking at is the Dow Jones relative to the S&P 500. And we see historically the Dow Jones really start to pick up at the back end of the year, starting off in September. And that's something we have been seeing recently. The strength, the areas of strength come from the non-tech sector. Generally, it's been tech that's really been leading the declines, and you can see that here. Now, this definitely calls for a full screener. I can even get my little head in here. So what we can see here is a breakdown in terms of, let me get the company logo off of that. Here we go. Let's see. So we can see a breakdown in terms of sectors over the past 2 weeks and see what's done what. So you can see at the bottom end of this chart, information technology and telecoms. That pretty much wraps up most of the big tech names. And so you can see massive declines as I speak, down 6%, down 5.8%. And that's what's been driving the weakness in terms of equity markets. You've also got some downside in terms of energy and materials. And that really highlights the fact that at the moment people are fearful around demand, certainly in China, alongside the US, and how that might impact energy. So demand for oil and gas, demand for materials. So we've seen some weakness in that as well. But what's notable here, if you look at the top end of this, okay, we've got real estate. That's planning for a period where we see interest rate cuts. So that stands to reason. We've seen utilities. Generally, that's a sort of a haven risk-off play. So that stands to reason. But then we've got consumer staples coming into play, financials, consumer discretionaries. They're all holding up very well, despite the fact that everyone's talking about the possibility of a recession. And so what does that mean? It means that potentially we're just seeing this rotation and people are getting out of these high value tech stocks. But also, it means to me that maybe this isn't so much just about the recession, because people are looking beyond that. If you're playing a potential recession by getting out of the stocks that aren't necessarily going to be that much impacted by recessions, that's particularly notable, because if you look at, say, semiconductors, they've been hit really hard. But semiconductors, a lot of them are going to be selling their goods to maybe other tech companies, maybe let's say NVIDIA, their sales are going to be highly reliant on the business that we get from, the likes of Alphabet, the likes of Amazon, or the likes of Google. And a lot of them have already made plans to spend huge amounts on some of these AI chips. Of course, other semiconductors are going to be selling products such as chips for like an iPhone or something like that. And of course, when you see recessions, you're going to see lower demand. But generally, if you're looking at those sort of high street names, a lot of them haven't necessarily suffered. Walmart doing particularly well, Amazon doing particularly well. So it's a very mixed bag here. And I wouldn't necessarily say that, this recession fear means that everything's getting sold off. It's not. The things that are being sold are tech, energy, and materials. So commodities and tech. And so, I think this is really interesting as we move forward, because clearly when we're talking about buy the dip, we're not even talking about buy the dip in everything, because not everything's dipped. The things that have dipped are the tech names. And so buying the dip in the NASDAQ or buying the dip in the S&P 500 is buying the dip in semiconductors or big tech, essentially. Now, one area I really wanted to point towards here is the Japanese yen. And so we've been talking recently about this unwinding of the carry trade over in Japan, which essentially is borrowing costs were rock bottom in Japan. So what people did was they would borrow in Japan, they'd put money into assets over in the US, and then they'd just make the difference between the two. So if you're borrowing an next to nothing and you've got tech names that are making, 10%, 15%, 20% in a year, then, that's a great strategy until you start to see that reverse. And we're now starting to see upside in terms of the Japanese yen. And the correlation that we've got here in terms of dollar yen weakness and the NASDAQ weakness really highlights exactly that. And that's why, in part, a 50 basis point cut from the Federal Reserve could do more damage than good. So, on Friday, we saw the jobs report, and part of the weakness we saw in terms of equity markets was off the back of this idea that, now we're not going to see a 50 basis point cut. However, if we were going to see a 50 basis point cut, everyone would start saying, well, look, clearly the Federal Reserve are desperate. The economy is going in the wrong direction and it's a recession thing. But it's also about the carry trade, because if we see that 50 basis point cut, what it could do is see a sharp move lower in terms of dollar yen. And as you can see here, a sharp move lower in terms of dollar yen is bad for equity markets. So that means a 50 basis point cut may not be what equity markets need right now. And that's certainly something that the Federal Reserve should be aware of as we move forward. So we have just heard comments from the BOJ. Some of the members or sources essentially saying that they don't see a reason for a rate cut this month. That's good news. So what we want to see on the Japanese side of things is moves to potentially weaken the Japanese yen, that could bring the possibility of a 50 basis point cut from the Federal Reserve. But we don't necessarily know that that's exactly how it will play out. And certainly we don't necessarily know that the BOJ are particularly interested in spending their time trying to weaken the yen, because their whole reason for raising rates in the first place was to strengthen it. But certainly they have seen the repercussions of it. So I think maybe they're going to hopefully take it a little bit more slowly. But I think the Federal Reserve, it's beneficial for them to take it slowly. 25 basis point cuts each meeting should keep it relatively slow and steady and stop a sharp decline in terms of dollar yen. Because if we do, then we're likely to see further weakness coming into play for the likes of the NASDAQ and tech stocks in particular. This is a chart. Excuse me, it hasn't necessarily been updated clearly because we haven't actually seen any selling pressure on this time around. So what it highlights here is in the election cycle, generally you see periods of weakness coming through September into October, and then we see the bulls coming back into play mid to late November. And so certainly the whole election cycle is going to be interesting here. And I'll show you exactly that in charting format. Now, we also have to bear in mind the fact that this is now the pivot, the big pivot from let me just change the view. So there we go. You can see all the numbers. So we're now pivoting in terms of monetary policy, right? And we've been talking about it for years. When are we going to see these rate cuts? Well, this is it, right? And so what's the outlook for markets? The market outlook is positive. The 12 months following each of these initial rate cuts have all been positive, bar two, where we saw significant economic collapses off the back of it. So I guess we need to question whether we're going to see that. I don't see a justification for a massive economic collapse. You know, if we see a recession, I don't think we're going to see a huge recession. You know, we're not in a 2007, 2008 position, quite frankly, despite the fact that, yes, we're seeing some softening in terms of a number of different metrics in the US market. And ultimately, as long as we don't necessarily see a second wave of inflation, we could see them start to pick up that pace, dollar yen dependent. But certainly this is really giving us the basis to think what we're seeing at the moment in terms of equity markets is a precursor to the bulls coming back into play. Now, first and foremost, I want to show you the chart for, here we go. Let me show you the chart for the S&P 500. Now, the S&P 500, we saw a sharp decline last week. We're trying to regain ground at the moment. And the question mark we have right now is essentially, is this the bottom for the S&P 500? And we push onwards and upwards from here. I have highlighted each of those election periods, pre-election periods in the past, right? So let's look at them. So this is 2020. We've seen September come into play, and we've initially seen a period of downside taking place over 3 to 4 weeks. We then saw a rally that took place over 2 to 3 weeks, and then we saw another 3-week period of weakness, and both of those lows came into the 61.8 Fibonacci level, and ultimately we then just within 1 week recovered the entire thing and pushed onwards and upwards from here, right? So that was the pre-election period. Of course, elections generally take place at the beginning of November, and so you can see the election essentially marked the beginning of the bull run coming back into play. Let's look at the next example. So here we go. So this is 2016. So we can see beginning of September, this is, so the first week of September, sharp decline. We then spent the next 3 weeks regaining that ground. And then we saw 1, 2, 3, 4, 5 weeks where we essentially fell back in towards that 50% down to 61.8 Fibonacci zone. So similar kind of retracement. This one's more protracted. But when we see the beginning of that election, that is your first big green candle. And once again, we push onwards and upwards and off we go, off to the races. So very similar to what we saw last time. And then this is the third example I wanted to give you. This is 2012, and we can see here. So let's look, where's September? So September here kicked off relatively positive. Then mid-September, we started to see selling pressure. This is more protracted. It took place over around about a month and a half, 2 months. And it was a little bit more of a delayed move post-election. And we ultimately saw that one big candle sort of grind higher over the next month, and then we pushed onwards and upwards, and off we go. And so where did this one come back to? 61.8. So the last 3 pre-election periods in September, we saw sell-offs. None of them were a single 1 week sell-off. All of them were protracted. They bottomed out around the 61.8 Fibonacci level, and the bull run kicked off back into play once we saw the election overcome. That to me points towards a warning sign that we've got potentially further downside to come over the near term for equity markets. Let me just get back to where we are at the moment. So if we're looking at this now, we would be pointing towards a potential, here we go, for, let's just get the election on here. So the election should be beginning of November. So let's grab this. So we're talking about the possibility of maybe something up here and then maybe down towards your 61.8, which is 5322. And then the possibility that the election marks the beginning of the next bull phase for this market. And so maybe this is just like recovery, consolidation, and then we see another sell-off at some point. Maybe we sell off into the 61.8 and then we see consolidation as we see some sort of holding pattern ahead of the election. But certainly as things stand, this does not look like the previous election periods, and therefore there is a good chance that we do see something similar playing out. So near term, yeah, maybe we see a bit more upside, but there is a very strong chance that we see another move towards the downside. Out of the last 3 occasions, none of them have seen a retracement as shallow as this marking the bottom. And so therefore the weakness we're seeing at the moment is indicative of a potential move lower for this market. Let me look at the hourly time frame. So we can see here that we've been creating these lower highs. Let me just try and put that on there. So 61.8 fib, and then this current move has come into, is this the 76.4? Let me just grab that. So this move has come absolutely perfect into the 76.4 fib and starting to see some weakness now. So certainly if we break up through this recent swing high that we have here, 5522, then it points towards that wider retracement coming into play. But there's still a possibility we come back down into your 61.8 because at the moment this is too shallow if you compare it to the previous occasions. It's certainly, we don't necessarily know whether we're going to see a recession, and the possibility of that coming into play raises further risk going forward. We still have big question marks that need to be answered, and ultimately it's not like the jobs report that's just been and gone is the answer to everything. We've still got a lot of questions that will flesh out over the coming months in the lead up to the election. Let me just quickly show you another couple of things that will be notable for this period. First and foremost, this is the price of gold overlaid against the likes of the Fed funds rate, or set against the Fed funds rate. And you can see these vertical lines. Those are the periods where we saw rate cuts, the first rate cut, and you can see bull market really kicking off there. This is a mid-bull market where we then saw a surge after that. And then on this occasion, it's really kicked off after this basing pattern and pushed the price of gold onwards and upwards from here. So gold looks like a potential benefactor for these rate cuts. Are we seeing the pullback that we're seeing elsewhere taking shape in gold? Well, let me just get this in a candlestick formation. Okay, let me not. What we can see here is essentially gold has been consolidating, but we're not seeing the selling pressure that's currently evident within the equity markets taking shape within gold. Also, it's notable that gold set against silver. If we look in the past, let me just bring it back to the weekly time frame. If we look at gold against silver in the past, we have seen the beginning of a easing cycle marking a surge in terms of gold against silver, a big surge here, gold against silver. And once again here, we saw that massive sharp rally for gold against silver. So the relationship between gold and silver is also likely to come into play. So be aware of that. At first, it could potentially be strength in terms of gold. And then the period after that, you can then potentially see silver outperform. So strength in terms of gold and then big outperformance for silver, exactly the same kind of thing here. So we'll be looking out for precious metals and saying, well, for the near term, it looks like gold is the one to be looking at. And so that's exactly how it's been playing out. Gold doing well recently. But beyond that, there's likely to be a period where silver starts to come into play. And finally, the dollar index. Like I said, I think there's a good chance that we're going to move into a period where we still do see some jitters, some consolidation, some potential downside in terms of equity markets. And we're also seeing the dollar index trading around this big support zone. We're starting to see the bulls coming back into play. I wouldn't be surprised to see some dollar strength coming in here. And certainly if we do see the Federal Reserve sort of holding off on those 50 basis point moves, which I think would be sensible, then we could see further upside here for the US dollar index. So the move through 101.917 required to provide that bullish near-term outlook for the US dollar. I hope this has been useful. Slap bang on half an hour. plenty to go through here, but a really interesting time for markets at the moment. And certainly there's plenty for traders to sink their teeth into. But just because equity markets go up over the long term doesn't mean it's necessarily going to happen immediately right now. There's a good chance with the election risk coming up that we might see some jitters. And if you look at historical occasions that we've seen this pullback in the September month, it often goes into November as well, even if it's consolidation as well. And then we see post-election, the bulls really coming back into play in a meaningful manner. But the one thing that really does seem to do well at easing cycles is gold. So certainly look out for gold and then silver and then the US dollar. Over the nearer term, it looks like we could see a bit of strength coming into play if you're looking at the FX markets.